Imagine the deep, resonant hum of a supertanker's engine, a sound that once echoed with the promise of global trade and prosperity. That mechanical heartbeat reverberated across the vast Pacific Ocean, connecting continents and economies in a web of energy and ambition. For years, this sound symbolized the steady flow of American crude oil to China's ever-expanding ports, fueling the world's second-largest economy and supporting thousands of jobs back home. It was more than just commerce, it was a pipeline of prosperity, a delicate dance of supply and demand that kept both nations intertwined. But now, that once familiar hum has faded, replaced by an uneasy silence. On August 15, 2025, China, the world's largest oil importer, stunned global markets by announcing a dramatic reduction in U.S. crude oil purchases, sending shockwaves through the energy sector. This wasn't just a business decision, it was a calculated move that signaled a profound shift in global power dynamics, with new alliances and rivalries emerging overnight. The story unfolding here isn't just about barrels of oil, it's about the intricate interplay of power, politics, and the uncertain future of globalization itself. When China makes a bold move like this, the ripples are felt in every corner of the world, from Wall Street to small towns dependent on oil jobs. It forces us to confront tough questions about our own energy security, economic vulnerabilities, and the true cost of global interdependence. Tonight, we'll explore the reasons behind China's decision, the strategies at play, and the far-reaching implications for the U.S. economy and beyond. The once robust energy relationship between the Eagle and the Dragon now stands fractured, with world leaders and citizens alike watching anxiously as events unfold. This is more than just another economic report, it's a pivotal moment that could redefine the balance of power in the 21st century, shaping the lives of millions. The world is now holding its breath, united in uncertainty, waiting to see what the next chapter in this high-stakes drama will bring. The U.S.-China oil trade grew rapidly, evolving from a minor exchange into a major artery of global energy flows almost overnight. This was a surprising partnership, one that emerged from the transformative power of the American shale revolution, which unlocked vast new reserves and changed the global energy map. In just a few years, the U.S. transformed from being the world's top oil importer to a major producer and exporter, rewriting decades of energy dependence. Meanwhile, China's energy demand soared to unprecedented heights, fueled by rapid industrialization and the rise of its middle class. American producers found themselves with a surplus of crude oil, searching for new markets to absorb their output. Chinese refiners, eager to secure reliable supplies, became enthusiastic buyers, forging new links across the Pacific. By the early 2020s, the U.S. had become one of China's top oil suppliers, sending millions of barrels each month. This trade was more than just business. It became a crucial pillar of the broader U.S.-China economic bond, supporting jobs, investment, and growth on both sides. Yet, beneath the surface, the relationship was always fragile, existing within a competitive and sometimes adversarial U.S.-China dynamic. Tensions simmered over trade imbalances, tariffs, and the struggle for geopolitical influence, casting a shadow over the energy partnership. Still, the oil trade stood out as a rare point of mutual benefit, a pragmatic arrangement amid frequent disagreements and diplomatic friction. Both sides understood that the flow of oil could be weaponized if political winds shifted, making every shipment a potential bargaining chip. Analysts repeatedly warned of the risks inherent in relying on a geopolitical rival for such a critical resource, highlighting the potential for sudden disruption. In Beijing, officials were acutely aware of their vulnerability, knowing that a single policy change in Washington could threaten their energy security. Leaders on both sides viewed the arrangement with suspicion, recognizing its commercial logic but wary of its strategic risks. The physical pipeline was strong, but the political foundations beneath it were brittle, prone to fracture under pressure. The events of this month proved just how delicate and precarious that connection truly was, as disruptions sent shockwaves through both economies. Ultimately, the energy relationship was a transactional arrangement, built on mutual need, but never rising to the level of a true strategic alliance. The connection was always susceptible to the seismic shifts of international power politics, a reminder that in the world of energy, even the strongest links can be the most fragile. To grasp China's impact, we must understand the global oil market. It's a massive, interconnected bazaar of producers, consumers, traders, and shippers. Oil is a global commodity, with prices influenced by supply, demand, and geopolitical events. Major players include the US, Saudi Arabia, Russia, China, and India. OPEC influences prices by coordinating production levels. The US, as an independent producer, is driven by market forces. Flexibility is key, oil is fungible, allowing buyers to find new sellers if supply is disrupted. A conflict in one region can spike prices elsewhere. China's decision reshuffles the global deck, forcing producers to compete for its market. The US must find new buyers for its oil, often at a discount. The global interconnectedness is both a strength and a weakness. On August 15, 2025, China's Ministry of Commerce made headlines by announcing a significant reduction in US oil purchases. This decision sent shockwaves through global energy markets and signaled a new phase in the ongoing economic rivalry between the world's two largest economies. State-owned energy giants, including Sinopec, received direct orders to sharply curtail new US crude oil contracts. This was not just a minor adjustment, but a sweeping directive affecting the entire Chinese oil industry. The move came on the heels of escalating diplomatic tensions over Taiwan, as well as the imposition of new US tariffs on Chinese goods. These political flashpoints have increasingly spilled over into the economic arena. Until this announcement, China had been importing around 1.2 million barrels of US crude oil every day, a trade flow worth billions of dollars annually and vital to both nations' economies. By cutting off this supply, Beijing delivered a powerful economic message to Washington, making it clear that energy trade could be used as leverage in broader disputes. In a strongly worded statement, a Chinese Foreign Ministry spokesperson called on the US to correct its mistaken actions and respect China's core interests, underscoring the seriousness of the move. This was economic statecraft in action. China was using oil, a critical resource, as a tool to influence foreign policy and protect its national interests. President Xi Jinping has repeatedly emphasized the importance of self-reliance and energy security, urging China to reduce dependence on foreign sources and strengthen its own supply chains. By cutting US oil imports, China is accelerating its long-term strategic goals, diversifying suppliers, boosting domestic production, and reducing vulnerability to external shocks. This shift also deepens China's energy partnerships with countries like Russia, Saudi Arabia, and Iran, further strengthening its position on the global stage. Ultimately, this move is part of a calculated long-term strategy, a step in a broader geopolitical realignment that is reshaping global trade and alliances. It wasn't just a reaction to recent events, it was a deliberate strategic shift designed to secure China's future in an uncertain world. The decision sent a clear signal to the world: the balance of power in global energy and politics is shifting, and China intends to play a leading role. Beijing's bold move marks a new chapter in the global energy game, with far-reaching implications for international relations and the future of oil trade. China's announcement shook global trading floors. West Texas intermediate prices fell sharply, threatening a U.S. supply glut. Stock prices of U.S. shale producers tumbled. China still needs oil, now competing for barrels from other regions. This increased demand raised global prices, widening the gap with U.S. oil. American consumers face higher pump prices tied to global Brent prices. The situation impacts the U.S. trade balance and energy sector jobs. Other oil-producing nations gain market share in China. Oil-importing nations face increased competition and higher prices. China's decision disrupts the global economy. The full extent of the damage is still being assessed. The economic consequences are significant and far-reaching. Experts weigh in on the complex situation. Daniel Yergin calls it a geopolitical watershed moment. The US-China energy trade was a bright spot, now extinguished. Beijing prioritizes energy security over market economics. Goldman Sachs highlights logistical chaos in rerouting oil. US crude must find new buyers, likely at a discount. Chinese refiners pay a premium for replacement barrels. Fiona Hill warns of China's use of import power as a coercive tool. The Biden administration faces a test of economic statecraft. A Texas shale producer's CEO calls it a body blow. Billions invested in export infrastructure now face uncertainty. The political fight in Washington costs jobs and investment. The energy industry expresses deep concern. The situation is a test of economic statecraft for the U.S. China's oil import cut is a geopolitical chess move. Beijing challenges the US-led international order. It's a power demonstration, offering alternatives to US alignment. China forges a new sphere of influence, focused on economic interests. Russia benefits, eager to sell more oil to China. The US-China energy divorce solidifies the Beijing-Moscow axis. Iran and Venezuela see opportunities to sell oil to China. The US faces a foreign policy dilemma. The shale revolution's promise of power is challenged. Washington must recalibrate its strategy. Middle East allies face a balancing act between US and China. They gain leverage, playing superpowers against each other. The global energy landscape is shifting dramatically. This disruption impacts everyday lives. Gas prices rise, hitting household budgets. The burden falls heaviest on lower and middle-income families. The shale boom created jobs, now at risk. A downturn in US oil exports threatens economic hardship. Inflation rises as energy costs increase. Higher fuel costs affect transportation and manufacturing. Central banks may raise interest rates, risking recession. The event underscores global interconnectedness and vulnerability. Decisions abroad affect financial well-being and job security. The human cost includes anxiety and uncertainty. The global supply chain's fragility is exposed. Economic instability forces us to confront our dependencies. We stand at a crossroads in energy history. The stable global energy flow era is ending. China's decision marks a permanent strategic shift. The future of energy is defined by geopolitics. Energy trade follows political fault lines, creating economic blocks. The US must strengthen energy partnerships with allies. Investments in renewable energy become a national security imperative. Individuals are called to understand energy systems. Consumer choices can shape the energy future. The global energy map is being redrawn. This is a story of conflict and opportunity. The response to Beijing's decision will define the future. The journey into a new energy era has just begun.